At 714.76, the SPY ETF is pressing against an all-time high. A price this elevated requires a rigorous mathematical evaluation to determine its sustainability. This chart shows the S&P 500 blended net profit margin. On the far right, the Q1 2026 bar reaches 13.4%, establishing an upward trend. This is the index's highest reported net profit margin since FactSet tracking began in 2009. This profit floor provides a verified underlying layer for the market. It offers a set of baseline conditions that allow algorithmic trading systems to operate at these price levels. However, fundamental data does not trigger algorithmic buying on its own. These record margins simply prepare the environment for the technical architecture to align. Current technical summaries for the SPY show unanimous consensus. Moving averages and momentum oscillators are locked into strong buy states across the daily dashboard. These summaries are aggregations of raw price derivatives, functioning as shorthand for the underlying math, not independent intelligence. To understand the strength of this signal, we must bypass the speculative options data and reverse engineer the observable price derivatives mapping this current trend. We will evaluate 4 specific vectors, including moving average alignment, short-term momentum oscillators, underlying volume behavior, and Fibonacci pivot levels. Deconstructing this signal's anatomy provides the data needed to separate structural support from potential exhaustion. We begin by stripping away all indicators to evaluate SPY's raw price action and determine the underlying trend direction. The simple moving averages reveal a specific bullish sequence. The 5-day SMA at 713 sits above the 50-day average at 711. Below that, the 50-day line sits well above the 200-day SMA, trailing at 679. This wide mathematical spread indicates a zone of structural support. This chart shows adjusted close price and moving averages over 400 days. Note the relationship between the orange 50-day and green 200-day lines during stable uptrends. This stacked SMA configuration acts as a sequence of support levels that absorb momentum during pullbacks. Because of this moving average alignment, the probability of an immediate, uncontained downside drift is lower. With the macro trend established, we turn to the immediate momentum oscillators to evaluate the energy driving the current price action. The relative strength index currently sits at 64.99. This position shows strong buying momentum, staying just below the 70 mark that triggers automated sell-offs. Cross-referencing with the MACD, we find a value of 0.760, remaining firmly positive. The ADX at 25.95 further suggests an established trend. Panels B and C on this chart track these indicators over the last 400 days. This historical data shows that MACD and RSI can sustain elevated levels for extended periods without forcing a trend reversal. The momentum metrics point to a mature trend rather than unstable or exhaustive volatility. To test the reliability of these momentum signals, we must evaluate the underlying volume data. Daily volume is inconsistent, fluctuating between 0.9 and 1.3 times its 10-day average. We monitor this using on-balance volume, a tool measuring total buying and selling pressure. We see a divergence here. Price momentum advances, but volume accumulation is flattening. In historic rallies, high-volume institutional buying actively drives the market. Currently, the price is moving forward on existing momentum, rather than consistent active pressure. This environment of grinding higher on low volatility requires a shift toward cautious observation rather than aggressive entry. To manage the risk of this volume divergence, we must define specific mathematical floors beneath the current price. The primary immediate floor is the Fibonacci pivot point, sitting at 714.38. Below that, a historical daily support level is established at 709.98. This defines a safe zone between the 50-day moving average at 711 and the Fibonacci pivot at 714.38. As long as SPY remains within this mathematical zone, the bullish structure remains intact, despite the inconsistent volume. Synthesizing these data streams into a single view shows how these technical layers converge. Note the cluster of support levels positioned just beneath the current price in the 711 to 714 range. Fading the oscillators reveals the price action contained within a well-defined support channel. The algorithmic strong buy consensus aligns with the underlying earnings data and the moving average stack. However, the main risk to this structure is the lack of consistency in institutional volume. Because the daily trading volume remains so inconsistent, a sudden influx of institutional selling could easily compromise this entire support architecture. The critical battleground for traders remains the narrow channel between the 713.79 Fibonacci support and the 714.38 pivot. Managing a move at these levels requires respecting the math and monitoring volume levels for signs of true institutional direction.